Welcome to the Art of Money podcast with Art McPherson.
And thanks for checking out the Art of Money podcast. My name is Mark Owens alongside Art McPherson and Luke McCarty. All the information for the McPherson Financial Group, you can find it at theartofmoneyradio.com. Do you find, Art McPherson, that some of your retirees, potential clients, they have that live for today mentality where they're only just thinking about getting to the next month, the next 6 months, and they're not thinking about the long-term effects of what a retirement plan needs to be?
Not too much. I mean, I think most people are thinking the long term and they want to make sure their money lasts long term, but they're worried that they get that Mark Owens mentality where if I buy a golf cart, can I afford that? Outside of my monthly income?
Because I was saving up for it. I did. I was able to.
Right, exactly. So that's as long as you're doing it that way. So basically you have a percentage.
Luke, I felt like I was about to get lectured right there, but I was like, no, I had the money. You know, I was ready for this.
No, this is the art of money. And if you don't have the money to buy the golf cart, Owens,
you don't need to buy the golf cart.
Yeah, so it's just the way you can derail a retirement income plan is if you're set up to take a 4% withdrawal rate or a 3% withdrawal rate, and then you on top of that withdrawal rate want to take another $50,000 that year, and it all of a sudden puts you in maybe a 7% withdrawal rate or an 8% withdrawal rate or a 10%. Well, you have to literally make 8, 9, 10% on your money that year alone just to keep even. So if you only made 7% or 6%, then you're losing principal. So you got to be careful of those kind of big ticket purchase items. And a lot of times people forget because most of their money is in 401k assets. Every dollar removed is taxable. So then all of a sudden you're jumping brackets too. So you had money taxed at 12%. Now that other money that you just pulled out as a lump sum of $50,000 is now taxed at 22. Or you were in the 22% bracket. Now it's taxed at 24. Or you're in the 24% bracket. Now that's taxed at 32. And an 8% jump on your bracket can make a big difference on your federal income taxes.
772-281-5223 to reach out to the team at the McPherson Financial Group. You know, it's easy to make mistakes when we plan for what happens to your stuff when you're gone. But the Go Banking Rates website says one of the most common mistakes is not considering the tax ramifications of what you're doing. Tell me why that's such a big deal, Luke McCarty.
Well, it's a very big deal. We've talked about it a little bit on the show today. Art mentioned it as well. If you take a lump sum out of your accounts, right, say you need 40 or 50,000, it may cost you 60 or 70,000 to do that. So you need to know what tax bracket you are in. You need to know how to manage your tax brackets. So there's a couple of ways you can manage those brackets, right? It depends on how you save going up into retirement. However, what we see is most people save in their 401k and it's all pre-tax. So now you have the problem of when I take money out, it's taxable. So now you need to do tax planning on the back end, which is what we do here and why we have Mark Bernard, our CPA here in-house. He runs an analysis on all of our clients that says, here's what we project your tax bracket to be at age 72 when you have your RMDs. Here's how we can pay less tax today for the next 5, 10, 15 years, whatever it may be, so you don't jump those brackets, right? When the Trump tax cuts are gone, here's what's going to happen. So maximize the low tax brackets now so you don't pay tax in the future. And in the future, right, the taxes could be on Social Security. It could be your Medicare premiums. It could be the rate of capital gains tax. I mean, this tax snowball, it rolls downhill and it gets larger and larger and larger if you don't look at it, if you don't plan for it.
And we still have Roth conversions on the table right now. So one of the things that we've been doing for a lot of our clients is looking and see if there's value to that for them, because currently our current president has said he wants to take that off the table. So while they're still allowed and we can still do them, they can be a great way to take qualified money that is 100% taxable and will be 100% required to have those RMDs that Luke was talking about, those required minimum distributions. We can transfer some of that money. The current code will end in 2026. So 2027 is a new tax code, which is basically the Obama-Bush kind of tax code period where you have a higher rate across the board. So even if Joe Biden doesn't change taxes this year, can't get it approved, can't get it passed, we know it's going to sunset and it goes back because their current code is just temporary. So now we know how to plan for that. Now, Biden has talked about speeding that up and taking away some of the tools we have today away from us. So why not take advantage of those tools that are still in existence right now and be able to reposition some assets at a lower tax bracket, probably the lowest possible tax bracket you'll ever have for your retirement.
772-281-5223. We were talking there about one of the mistakes that we make is not considering tax ramifications in your moves. Well, think about some other mistakes that potential retirees, pre-retirees, clients make when they set up that first consultation. And mistakes like, not thinking about long-term care or not being diversified enough. Off the top of your head, what are some of the big mistakes that we make?
I'll give you a couple examples. So we had a couple people in this last week where we were talking to them. One of them had not considered long-term care at all, but they came in and they were looking at it very, very carefully because they had a parent now going through it. So long-term care is expensive. It's about $7,000 kind of on average right now if you have a loved one going through that. So how are you going to pay for that? So if it's $7,000 a month, that's got to come out of some nest egg somewhere. And before Medicare will take care of it, you've got to be out of money. So you can burn through a $500,000 portfolio pretty quickly at $7,000 a month. So it's trying to protect our clients from having to have all this money they thought were going to go to the kids and grandkids just go to a facility while they're, not feeling well.
Luke, same question to you. If you meet with a new potential client for the McPherson Financial Group, what is something you see as you're going through a portfolio, some of the mistakes that you see?
I think some of the mistakes I see quite often is people anchor to their investments, and meaning they bought an investment, it hasn't worked out, but they think it's coming back. So you anchor to it by, I can't sell it now because it's down.
Right.
And you just keep going down. And I can't sell it now because it's down further. So there's been, the last 10 years in the stock market have been, extraordinary, for rate of returns and just how the market's done in general. The last 10 years, you shouldn't have many losers on the books, which makes it harder to do some tax loss harvesting, but that's a good thing. So we see clients anchor to certain investments, and then, to tag on to Art's long-term care, a lot of clients don't think about or know how expensive health insurance is before age 65. And, just the rules of COBRA, how expensive COBRA can be, that COBRA only lasts for 18 months. So if you retire at 62, right, you have another year and a half you need to get from 63 and a half to 65. What are you going to do? So health issues, and then, just having a internal bias on certain things that are going on in your portfolio.
We're talking about the market a lot this week and having good tax strategies. What about inflation, Luke McCarty? Are you getting calls about inflation? Is it still a number one concern on pre-retirees' minds?
It's still a very big concern. The major piece of that is people that have too much cash on hand, right? If you have too much cash in the bank, you're losing money, right? Inflation's 6-7%. Well, your cash you have in the bank, if you have $100,000, it's only worth $93,000 now. So finding safe assets that pay a rate of return that can keep up with inflation, that's what we're seeing as a major concern. Now, our portfolios are designed to keep up with inflation and continue to grow over time. So, our clients were able to get a pay raise this year if they wanted one. So, it just depends on the client. But I'd say safe money right now is the hardest part for an individual investor to find a good return on safe money, because bonds are losing money. CDs aren't doing anything. Your bank's not paying you anything. Your real rate of return is negative 6%, or negative 7%. Because I think I get a quarter, 25 cents a month for my savings account. So it's pretty silly at the moment.
But you don't see the money going down. But what happens is what the money can buy. It takes more dollars to buy the same thing. So when we go to the grocery store, it used to be so much per pound for your meat. So when you go buy a block of hamburger or you buy your hamburger meat, you're paying X. Now you're paying XX. And same thing for boxes of cereal, same thing for everything across the board. So whether it's stuff for Luke's new pool, or if it's stuff for my boat, or if it's stuff for your golf cart, or if it's stuff that we're consuming as food, everything has gone up. And some of the things that have gone up at a very rapid rate, much higher than 7%. So that's where that dollar that's sitting in the bank, yes, it hasn't gone down the last 2 weeks when the market has, but it's also costing you money because it sits there and it's not making you positive growth or positive interest. So making sure you have some of that money working for you in a positive way.
Talk about first world problems. I have to put the 90 octane in the golf cart, and it's like $3.50 a gallon.
Is it loud?
It's not super loud, but there's definitely a and the only thing I don't like about it is the exhaust is right up underneath the driver's seat. So I don't know if it's the cocktail in the cup holder or the exhaust, but sometimes I'm feeling pretty good driving around the neighborhood.
You might want to put a muffler on it.
Just a heads up to the neighbors.
You might want to put a muffler in a tailpipe instead of the exhaust going straight up into you.
It's kind of fun.
Hide your kids, hide your wife. Here comes Owen.
Thanks for listening. Want more from Art McPherson of McPherson Financial Group? Find us online at artofmoneyradio.com.
We are an independent financial services firm helping individuals create retirement strategies using a variety of financial and insurance products to custom suit their needs and objectives. Securities offered through World Equity Group, Inc., member FINRA and SIPC, a registered investment advisor. Investment advisory services offered through ProStatus Group, LLC. McPherson Financial Group and ProStatus Group, LLC are separate entities and are not owned or controlled by World Equity Group, Inc. Exposure to ideas and financial vehicles discussed should not be considered investment advice or recommendation to buy or sell any financial vehicle. Past performance is not a guarantee of future results. Investments can fluctuate and when redeemed may be worth more or less than when originally invested. Investment financial professionals are not licensed in all 50 states. Art McPherson is not affiliated with nor endorsed by the Social Security Administration or any other government agency and does not provide legal or tax advice. Please consult with your attorney, accountant, and or tax advisor for advice concerning your particular circumstances. Annuity guarantees rely solely on the financial strength and claims paying ability of the issuing insurance company. By contacting us, you may be provided with information about insurance and annuity products offered through Arthur McPherson, Florida Insurance License number A174725.
Today's show has been a work of art.